when I first got elected, I'm just going to take a point of personal privilege, committed to attending as many of these meetings in person as possible. The State Investment Council is important to us. Your role, this committee's role, and not only behaving and acting as the fiduciary that we are, but really looking for any investment opportunities and strategies that reinforce our values and goals and create the kind of differences and ecosystem for New Mexico businesses that we all desire. And I'm grateful. I didn't have to worry about any of you at all. You're amazing. The team at the State Investment Council are amazing. Director Moise, I appreciate that you got everything you needed to get done. We're very active in the legislative process, and to every member who's continued to sacrifice and provide valuable personal time to this mission. I'm very grateful, and I'm looking forward to when I can see all of you in person. And if I appear a little rusty, I do better when we're all facing each other. But without any further ado, let's have a roll call. And I don't know if I need to make any introductions today. Director Moise, I'm going to give that to you if there's some that we need to make as we need to make them. Can I do that?
Thank you, Governor. I think it would be great if Carrie would go ahead with roll call.
Great. Thank you, Carrie.
Good morning, everyone. Let me start with the council. Governor Lujan Grisham.
Present.
Commissioner Garcia Richard.
I'm here, and I'm so glad to hear your voice, Governor. Welcome.
Oh, Commissioner, it's been a long time. Nice to hear you.
Treasurer Eichenberg.
Present, and thank you, Governor, for joining us today.
You're welcome. Thank you.
Secretary Romero.
Present.
Tim Jennings.
Present.
Harold Lavender.
Carrie, this is Harold. I just wanted to say hello to everyone. I think this has been a difficult time for me. We had a medical emergency and a medical issue. Steve, I've been in contact on a regular basis with Steve, and he has conveyed to me a number of instances of people asking about me. And if you've never been in this situation, you can't imagine how incredibly I don't know what the right term is, wonderful it is that people are concerned and have asked. I'm probably not going to be able to stay on the call for the entire time. I'm just going to listen. I have read all the materials as always, and but I'm just going to listen today. And when I have to disappear, I'll just be a beep beep when I'm gone. But I just want to say that I think all of you know how much this means to me to be a part of this, and I'm really pleased that I could at least check in today.
Thank you, Harold.
Lee Rossman.
Present.
Mike Messina.
Present, and I have a couple of comments. First, I wanted to say, Harold, I hope you're on the mend. I've been asking about you. I wish I had called. So nice to hear your voice. I'm really happy that you're getting better. And Governor, I can't wait to see you in person. Speaking of COVID.
Me too, Mike.
Nick Tayet.
Present.
Catherine Allen.
Present, and Governor, it's nice to hear your voice. Hope to see you soon.
Same. Thank you, Kathy.
And John Bingaman.
Present.
Governor, you do have a quorum.
Thank you, Carrie. With that, I would entertain a motion to approve the agenda.
So moved.
All right, we've got the land commissioners moved. Do we have a second?
Second, Kathy Allen.
Thank you, Ms. Allen. Member Allen. Okay, I thought somebody was. Is there any discussion, questions, concerns? Hearing none. All those in favor say aye.
Aye.
Aye. Aye. Aye. Any opposed?
Aye.
Any abstaining? Motion carries. All right, next on the agenda is the approval of the minutes from the April 27th, 2021 meeting. Do I have a motion to approve?
Motion to approve?
All right, and who was that?
Stephanie.
Ah, thank you, Commissioner. Do I have a second?
This is Kathy, second.
We have a second by Member Allen. Do we have any comments, questions, concerns? Amendments? Hearing none. All those in favor say aye.
Aye.
Aye. Any opposed? Any abstain? The motion carries. The minutes of April 27th are approved. Next on the agenda, we've got our Director Investment Officer report. So I'm going to go with item A, and it's the State Investment Officer report. You're on, Director Moise.
Thank you, Governor. If each of you would take a look at the briefing sheet, which is in your materials, please. We'll start with opening comments. Current net asset value is $33,376,000,000, just a little bit short of our all-time intra-month high. For May 21, total distributions over the last 12 months have been $1,065,000,000. Looking at the price of West Texas Intermediate oil, the New Mexico price as of close of business yesterday was $65.97. The $66 mark is an interesting number as we look back at oil over the past 10 years or so. You might recall that in 2011, we hit $106. That's on Brent, I believe, not on WTI. And then in 2014, we hit 105. And as of now, we're at about 66. So oil is coming back. Rig counts also are increasing. From May last year to May this year, we've moved in New Mexico from 65 to 72. So that's encouraging. I would like you to take a look, if you would, at Section B, Investment Matters, under subsection 1 and subsection 3. The 10-year growth in net asset value and the corresponding 10-year total distributions. Those two numbers tell a story. And the $14 billion 10-year growth in our net asset value and the total distributions of almost $9 billion over that same period are worth noting. Do want to thank Clayton Cleek, who has done a marvelous job for us as a public equity analyst, for all of the wonderful work he has done. Clayton is a real treasure. We're going to miss him as he goes across the street to PERA. We congratulate him on his new role there, and we will, of course, keep in touch. I also want to thank Consuelo Annan for the good work she's done in our IT department. She's retiring. Consuelo has been a wonderful person to work with, very pleasant and highly professional. So thank you to both of you. Vince and or Brent may have comments a little bit later. Take a look, please, under Council Matters, Section C. You heard from Harold. Harold has really been through it, but he's coming out of it hopefully stronger and will be back with us soon. So as we all know, He's a valuable member of the council. Mike Messina will be standing in as the acting chair of the investment committee this morning. Under governance committee, Kathy and Mike Messina have spoken with each other, and Kathy will be covering that matter a little bit later in the meeting as it appears on the agenda. Under section D, operations, we're going to be hiring a new public equity analyst, a new IT professional, and we continue to look for a financial analyst. As all of you know oh too well, we've been working remotely for about 15 plus months. Governor, you've done an excellent job of guiding us through this, and we can't tell you how much we appreciate it. We do look forward to getting back together in person.
Me too. I just didn't mean to interrupt but that was very kind of you. Thank you.
And it's heartfelt. We will be developing a plan for returning to the office, and we'll be implementing that as soon as we're permitted to do that. Our management group is considering a lot of different options. Brent will be covering the IHR, and there's some interesting numbers in there that I'm going to leave it to you, Brent, to cover in your report. Now I'm going to ask Charlie, if I may, to comment on the New Mexico Recovery Fund and the Small Business Recovery Act, as well as a few client matters. Charlie, please.
Thanks, Steve. Good morning, Governor, members of the council. I will be brief. The New Mexico Recovery Act and the recovery loan program being managed by the New Mexico Finance Authority that uses $500 million of severance tax permanent fund dollars has drawn down an initial $20 million in fresh capital this month. The loans are being awarded, and that's on top of the $41 million or so that was originally loaned through the initial small biz loan program last year. In addition, New Mexico Finance Authority is administering a $100 million LEDA business grant program that will also be supporting businesses, and that uses general fund money. The council's New Mexico Recovery Fund, which is managed by Sun Mountain Capital, that's now awarded $74 million in loans to 27 medium to large size New Mexico businesses, with another 3 that are in final legal review. If those are approved, the SIC's loan program will have deployed $87.7 million out of the original $100 million fund that the council approved early last year. Regarding SIC clients, we continue to see some new interest from entities, including current clients as well as prospective groups that are looking to invest long-term capital. While there are no new agreements at this time, there does seem to be a growing interest in participating in not only the SIC's low-cost traditional stocks and bonds pools investments, but also non-traditional investment offerings like private equity, which are difficult to access for most non-institutional investors. At the end of April, there are 22 government entities with 41 accounts investing $1.62 billion in the SIC's investment pools. 5 years ago in April, we had fewer clients, but also much fewer dollars, with only $790 million assets under management for the clients at that time. That's less than half of today's. Governor, members of the council, I have no additional comments.
And Governor, that also is the end of my report.
All right, thank you. And so are we on then item B of section 2? Or did we get both of those at the same time, correct? We're all done?
Yes, and correct, Governor, we're ready to go to 2B.
Okay, terrific. Then let's go to that order of business.
Okay, well, thanks, Governor, and thanks, everyone. Good morning.
Good morning.
We mentioned last month that some change was afoot in the economic and markets environment that we're operating. First and foremost, we're seeing a pickup in inflation. I'm sure you all have been reading about that in the newspaper. It's something that has been expected. April CPI was 4.2% higher than a year ago. As you can recall, we've been running inflation anywhere from 1.5% to 2.5%. So a big jump over numbers that we're accustomed to seeing anyway. There were some distortions in that number, though. Prices that actually dropped a year ahead of that, and so some of that increase was just that rebounding. And then there were some big price increases in just a few items. In particular, used cars, where a computer chip shortage has been slowing new car production and increasing demand in the used car market. So prices there jumped a lot, and that also fed into the price increase. Second, payrolls came in at 266,000 in April, up from March. The main survey of economists that we follow were expecting 1 million new jobs, so a huge dip in job creation. Again, there were some additional or some unusual factors at work there. Among them was the extended unemployment benefits that are still in place, and some other things that held that number back. Markets faltered a little bit on the news. I think overall, and the governor touched on this earlier, overall economists are continuing to expect that the Fed's easy monetary policy and federal spending plans will push the recovery to continue, and see those jobs continue to come on and faster than that 266,000 pace we saw for April. But not without setback. We'll certainly see the occasional setback like we did here in April, and certainly not without risks. Of course, the two big risks that we're facing are the inflation risks. The Fed's been communicating that they think the recent increase or the April increase is transitory, and maybe we'll have a few months of numbers like that, but we'll settle back down in that sort of 1.5% to 2.5% range. That's their expectation. I think probably if we looked at most of the surveys, that's what the market is expecting too. So the risk there is that inflation actually gets a little sticky, and we see higher numbers for a longer period of time. So we're keeping our eye on that. Second risk is one that's been with us for quite some time, and that's the high valuations on markets. Everyone seems to understand that stock valuations are where they are due to loose monetary policy by the Fed. Also, the Fed purchasing a huge amount of bonds each month, putting more liquidity in the system, and then big spending bills that have come through Congress have pushed these markets up to very high levels. So when all that starts to draw to a close, letting the air out of the bubble that we've got going, will be kind of an interesting thing. So I think from our positioning, we've been positioned well. Over the past several years, we're about our maximum diversification. So we've got a lot of different asset classes, a lot of different investment types in the portfolio. So whichever way the economy goes, we've got something that'll benefit, and not a lot in one basket that can get hurt. So I think that's the right strategy going forward. We've got three best allocation recommendations for you later on in the meeting, and you'll see that diversification theory continuing to play out here, and we'll be able to talk about that a little bit more when we get there. So with that, Governor, I'll wrap and leave it to you to move us to performance.
All right, thank you very much, Mr. Smith. Let's then go to that order of business, which is the performance report. Thank you.
Okay, well, thanks. And I'll just start out with just a couple of comments, and then as usual, RBK will work you through that line item. This is the executive summary, so it's the quarterly report. We normally spend a little bit more time on this report with you. I think, you'll see some pretty big numbers when we get there. And it's a lot from the recovery from the lows in March of 2020, so we're a year on from that. Don't expect those to last. I wouldn't expect. but they're nice to look at this point. We've seen some of the areas of the portfolio that have been lagging for us starting to improve. That's good. So it's kind of a broad-based, even though those numbers are large, it's quite broad-based, and not just one or two asset classes really driving things. We're seeing good returns across the board. So with those brief comments, let me turn over to Marcia and Matthias, and they'll be able to walk you through the report.
Good morning. Nice to hear your voice, Madam Chair. Nice to have you back. And would love to be there and see you all in person. But happy Tuesday, council members. And we'll go through the quarterly report. Vince has made comments on the market. I will show you some numbers. I'm going to ask you to go to Diligent, page 34, and we'll just set the stage for the performance that you're going to see. As Vince said, equity markets have been quite strong. I looked back to a quarter ago, and your March 30th performance in 2020 for the quarter was a negative 9.71, and the one-year number at that point was down to just under 2.5%. So things have changed. If you look at the left-hand bottom side of this page, you'll see performance. The second column is for the quarter, and then the third column is for the 1 year. And the returns are extremely strong for equities, small cap, just really strong performance for the quarter. But I'll ask you to look at that 1 year return. S&P up over 56 for the 1 year period. Small cap stocks domestically up over 94%, almost 95%. And outside of the United States, doing well also, but not quite as good as the U.S. But these numbers are, like Vince said, please, don't expect those going forward. They're certainly not sustainable. And, valuations are at all-time highs, especially in the U.S. markets. And the U.S. market is actually almost priced for perfection. And we know nothing is perfect. So strong performance. I ask you to go to the right of that performance chart and look at the yield curve. The yield curve, orange, is where it was March of 2 years ago. And you'll see that that was an inverted yield curve. And then fast forward to March 20th with COVID, and you can see that yellow line, and the yellow line is reflective of, the Fed policy with COVID, and rates took a steep, deep dive down, and that was actually good for fixed income market returns in 2020. Now, if you go from the yield curve, the yellow to the green, that takes you from last year to this year. Rates have moved back up. The Fed said they're keeping policy where they are. They can control the short end, but they lose control as the yield curve goes out longer. And you can see how steep that yield curve has gone, how steep the yield curve is. And so rates went up, and that's negative for the fixed income market. So if you look at the left-hand side again, you can see the Bloomberg U.S. Ag. The quarter was down over 3%. And if we incorporate that into a 1 year number, the Ag is at 0.71. Other numbers that are worth, no surprise to you, that the commodity index had a strong quarter, up just under 7%, and a 1 year number of 35%. So strong performance in the markets. A little scary. Matthias, we've talked about our return assumptions, and you'll see those as we're talking about asset allocations. Our assumptions are not expecting anywhere near the returns we've seen in the equity markets because things are so high priced. On page 35 is our quilt, what we call a quilt chart. It shows the best, how the asset classes performed by calendar year, and to the right is the first quarter of 2020. As I mentioned, small cap mid stocks in the U.S. quite strong. What was the worst performer so far this year? And that was long bonds, as expected after the discussion on the yield curve. I will mention that this was talking about inflation. We've talked about what our inflation expectations are. Certainly, the news has reflected a higher inflation. We do believe it's transitory, and we could see it higher for 12 to 18 months, but we expect it to be more short term, and that longer term inflation will be back in line with what we've seen longer term. So with that, let's go to page 37 of your diligent report, and this is looking at your allocations for land grant and severance relative to their target. On the top left, we're looking at land grant. Just a couple comments here. You'll see a no in the column of core fixed income. That's been the case for a while. As your allocation to fixed income, the target is at 10, you're at 12. Funding in, you've seen investments come, bringing investments into that non-core fixed income, shooting for that target of 15%. We're now, at the end of the quarter, you're at 12%. Also, in the asset allocation study, we'll be talking about real return, that you can see you're underweight relative to your target there. It's been harder to implement up to that target, and we'll speak to that a bit later. But all the other asset classes are within their ranges. For severance tax, everything is within your policy expectations. On Diligent 38, we're looking at allocation versus target for some of the other funds. Point out two things: tax stabilization, which is on the top left-hand side, and early childhood. We'll be talking about early childhood in the asset allocation discussion today. But comments for both of those allocations, you will see no equity in that. That will likely change for early childhood, but with no equity in the allocation, you'll see in a moment that their recent returns have been negative because they are mostly fixed income with some alternatives or some privates in there as well. So now let's look at performance. On page 40 of Diligence, we look at performance for your investment policy on a 5-year basis, and your expectation is to beat your policy index over that 5-year period, and that's been the case for the land grant. Land grant outperformed its benchmark by 40 basis points, so it's in line with policy expectations. Right below that, you'll see severance tax. Severance tax did not beat its policy index, so you'll see the no reflected there. So that's for the 5-year. Below, you'll see land grant and severance for the shorter and longer time periods for the quarter. And fiscal year to date, we've seen a good turn in that the land grant actual performance on a net of fees basis has beat the policy index. This has been a harder period to do that longer term, but it's nice to see those numbers on the fiscal year, 1 year outperforming your benchmark. Severance tax, a little bit different story. Outperformed for the quarter, not the case on a fiscal year to date basis for the 1 year or longer term periods. And we'll look at that in a moment as well. So looking at land grant for the quarter, most of your return comes, and I'm on page 41 of Diligent, this is attribution. So as Matthias and I have said many times, and your staff, that we believe most of your return comes from the asset allocation, and this attribution chart is reflecting that. The strategic asset allocation was the primary driver of return. That's comparing the green, which is your actual performance, to the blue line, We also saw for the quarter some manager value add. That is the more purple line. And you can see on the columns, the last column, where that outperformance manager value add, where we saw it in many of the asset classes for the quarter. On page 42, for the 1 year period, manager value add was actually negative. It was a very difficult time to outperform benchmarks. But again, most of your return came from your asset allocation, a little negative from the manager value add. Now, we not fast forward, but we move on to the severance tax. And on page 43, this is for the quarter. A little, again, most of the return coming from asset allocation, and there's manager value add here. But when we looked at land grant, we saw that on the private equity, it was flat. Manager value add actually negative here for your private equity, and that's the case for longer term numbers that we're seeing because of the different makeup of the private equity within the severance. It has been a detractor from performance. Going to page 45, and let's look at 45 first. This is looking at for the quarter, which is calendar year today, for each of the funds, their beginning balance or ending balance and the returns. On this page, you'll see tax stabilization with a negative return. As I pointed out earlier, no equity in their allocation, so that drove the negative performance because fixed income returns were negative. If you go to page 46, you can see the same is true for the early childhood with a negative return. And this is just for a quarter, but a negative return of 1%, just over 1%. Longer term performance for the other funds are shown on page diligent 47, but let's go to peers and look at your peer performance. And there's no policy objective to outperform your peers, but we always look at how you did versus your peers. It's interesting information, but it's not an objective for your performance. On this chart, on this table, the land grant is the actual performance is at the very top. So the quarter of 4.38. If we look at the universe right below that, the universe that we typically compare you to, which we think is the most appropriate, is the all public plans greater than $1 billion. And the median return for that universe was 3.33 for the quarter. So you ranked very well. You ranked in the 12th percentile for the quarter. Now for the 1 year, your rank is 84th percentile, but again, that was a period, it's hard to say that you returned 26%, that was below median. The median was at 3.115. So that's just 1 year, but let's look at 3, 5, 7, all the trailing periods. You can see that your ranks improve the longer out. 5 years, you're close to median. If we look at 7 years, you're 46th percentile, 10-year, 43rd percentile. Again, just above median for that long-term performance gives you that consistent outperformance. So that's looking at land grant. A little bit different story. Well, I will take that back. We'll look at severance in a moment. But if you go to page 56, this is looking, again, your policy expects, wants you to look at 5 year. So although not an objective, we do look at your rolling 5-year ranks compared to your peers, and looking at the right-hand side of your chart, for the most part, in the last several years, you've consistently been above median. This last year, you fell below for a period. We expect that to go back up, but you will see that you are below median, but the consistency of the years before, not being at the top, not being at the bottom, but consistent above median performance is a great place to be to get to those consistent long-term outperformance. Page 51 looks at risk-adjusted returns, or the Sharpe ratio, and we believe it's important to evaluate risk and reward together. In this case, with the Sharpe ratio, you're consistently in the last several years in the top quartile. So taking risk into account, when you're talking about return, you're in a great place. You're in the top quartile. Now we'll go to severance on page 52 of diligence. Above median performance for the quarter, but not as good of long-term ranks as the land grant fund. This has been consistent over time. So below median ranks for the severance tax fund. Let's go to page 54 and look at risk and return. The left-hand side is looking at the universe of public plans greater than $1 billion. The top chart is looking at the 5-year period, the bottom the 10-year period. The lighter gray dots are the peers in the universe. All of your benchmarks and performance are on top of each other. The land grants actual performance is a green triangle, and severance tax is blue, but they are, all covered up by the index, so it means you're at your targets, very close, and you fall very close to the northwest quadrant. You have below median volatility compared to your peers, and around median performance. So if we look at that 5-year chart and we look at land grant with a return of 5-year return of 9.48, that was for the land grant total fund. The median number is 9.7. So what's that tell us? That the land grant has 98% of the return of the median plan. But if you look at standard deviation, you'll see your standard deviation is much lower. So to the, on that chart to the left-hand side. So looking at your standard deviation compared to the universe median, you had 98% of the return at only 74% of the volatility or standard deviation. That's for the 5-year. For the 10-year, you had 101% of the return, but at only 86% of the volatility. So that's exactly where you want to be, at or above median return, but you didn't have to take as much risk to get there.
Can I ask you a question just for a second?
Sure. Sorry.
You said, now page 19 is less than $1 billion, right? In the 5-year rolling average. What is the difference between page 19 and 20? They both are less than $1 billion, right?
I'm looking at the pages here, sorry.
Oh, well, it's page 50 and 51 or 19 and 20 in your RBK report.
So they're looking at the, you're looking at this, I'm looking at page 8.
It's a land grant rolling 5-year peer rank, all public funds, less than $1 billion. Well, the same one, the next one is land grant rolling Sharpe ratio, 5-year average, all less than $1 billion, right? I thought you said one of them was more than public plans of more than $1 billion.
They're looking at public plans greater than $1 billion. All those charts, and even on, and I'm sorry if I misspoke, but pages diligent 49, 50,
okay,
and 51 are looking at public plans greater than $1 billion, and the left side of diligent 54 is looking at all public plans greater than $1 billion. So the same universes, same comparisons.
Oh, okay. All right, I'm sorry.
No. I'm sorry I didn't pause and ask for questions.
Thank you, Member Jennings. Go ahead unless you've got other member questions. I just was going to invite that response. I'm sorry if I was slow on the get-go as well.
Okay. Thank you.
You're welcome. Anyone else before we? All right, proceed.
Okay, thank you. So we'll now look at the asset classes. So I'm going to take you to page 58 And this is looking at the U.S. equity structure. And on page 58, it's an update, and there really is no update. There were no manager changes. You're at very close. You're at your, there's no interim target anymore. That your U.S. equity allocation is 20% of the total. And there were no significant manager events to report to you for the quarter. So that's good news. The next page is looking at how U.S. equity performed. And you'll notice at the top, there's a no there. You've made some structural changes to your equity portfolio, and they're paying off. So for the 5-year period, you trailed the Russell 3000 index, and I will say you're not alone there. It was a very difficult period to outperform the Russell 3000 or other indexes. Active management, it was for a balanced active management without style biases. It was difficult to outperform over that 5-year period, but you've also made some structural changes. So you will see for the in the table down below that the U.S. equity on a net of fees basis for the quarter was up over 7% compared to the benchmark was at 6.35. You'll also notice for the fiscal year to date, outperformance net of fees outperformed, and then 1 year trailed slightly. But I mean, the U.S. equity portfolio, which is close to 20% of the land grant, returned net of fees 61%. Again, please don't expect that going forward, but it was nice to see that return. If we break your U.S. equity composite out by what is large cap for the quarter, again outperforming its benchmark for the quarter, your large cap piece of the U.S. equity portfolio was at 6.45. But the small cap, as I mentioned at the very beginning, small cap had a run, and your small cap portfolio just for the quarter beat its benchmark that gave you a 13.4% return. And I'll take you over to the 1 year number, a 99.11% return for small cap for the year. And really, although not as strong as small cap, your large cap was up 58.4%. So U.S. equity performance has been incredible. On page 60, this is looking again at risk and return and a universe of other U.S. equity segments. And you'll see that your U.S. equity, although you didn't beat the median U.S. equity, you had less volatility than the median U.S. equity segment. So 5-year return of 15.89, below that, but had less risk getting there. Now, if you're interested on the page 61, just take a quick glance, and you'll see you're very close to the Russell 3000, both on a market cap and on sectors. Took away some of the biases in your portfolio, and you can see it's paid off. On non-U.S. equity, beginning on page 63, again, nothing to report here. No manager updates, no terminations, no additions. So we'll go to performance on page 64. Although U.S. equity trailed for the 5-year, your non-U.S. equity portfolio did meet its policy expectations on both counts here. If you look for the quarter, comparing you to the universe, a below median rank for the quarter, but you had a return of 4.11, and your index was at 3.77. If we break that out between developed markets and emerging markets, see the developed markets actually outperformed emerging markets, and both of those segments outperformed their benchmarks for the quarter. Similar information on 65, looking at lower volatility on a risk-return basis, but below median returns for this 5-year period compared to the non-U.S. segment of other plans. And on page 66, looking at your portfolio in green compared to your index, on market cap on the top and on regional below. So most of your portfolio, or a third of your portfolio, is in Europe, outside of the UK. On fixed income, page 68, no manager changes here. You are, you can see that you're not in your policy targets. We talked about that at the beginning, but you're moving closer. If we look at performance, for your core portfolio, beating the expectations set in your policy. Looking at your non-core, there's a no, but it's only 1 basis point of below expectation, so I think that's pretty close. As I mentioned, short-term performance for core fixed income has been difficult. It's been negative fiscal year to date, down 24 basis points, but doing much better than its benchmark, which is the ag, which was down 2%. So performance in this difficult market is you've been protected. Your non-core fixed income, also a great diversifier here in a period of difficult period for core fixed income. You can see positive returns from your non-core fixed income, which is great diversification, also giving you yield. On page 70, looking again at risk return, falling in that northwest quadrant where you have above median return here at below median volatility. And then we look at alternatives, and you receive reports from your specialty consultant. So I'm not going to go into those performance there, but that is shown on slide diligent 72. Matthias and I are happy to take any questions, go into more detail, whatever is your pleasure. Thank you, Madam Chair.
Thank you. Do any members have any comments or questions? All right.
Madam Chair, this is Tim.
Okay. Mr. Treasurer, please go ahead.
Thank you. Marcia, I should have asked this back on page 56, but would you go back to page 56? You're page 25. And under private equity composite, 2 questions for you. And one is, why did you use all country world index? Because most of our investments, I think, are in the United States. But will you explain the last line, the difference? Because it just doesn't look right to me. And I guess that's what caught my eye. So can you go through that? Kind of explain to the listeners that I am.
This is the difficulty of benchmarking private equity, and we are using a global index because you do have some exposure to non-U.S. in your private equity. But this is a publicly traded benchmark, and we looked at the returns of publicly traded equities have been quite strong. Going to that first page of the report, and we don't have world in here, but if you took the S&P, the Russell 2000, and then all of the MSCI indices, for the 1 year number, there's not one of them that is below 40% return. The lowest was the EFIS, the Developed International, that's almost, above 44%. So you're taking a public global benchmark and adding 300 basis points to it. You can't go out and invest that. And it's also reflective of, the high valuations, especially in the U.S., but in non-U.S. to a certain extent as well. So strong public equity plus adding 300 basis points. It's a long-term benchmark. It's meant there to be what is the opportunity cost of being in private equity and not being in public markets. And it's hard to look at that benchmark when the equity markets have been so strong. So, in other words, your 1 year number for the private equity portfolio, there's nothing wrong with a 20% return. Now, Cambridge did a little bit better, but the benchmark world, so the global market, plus 300 basis points was 59%. So that's a benchmark. Again, you can't invest in a benchmark that is there for long term, actually, and because public equity has performed so well, it's even affecting the longer term performance as well. So again, it's just valuations are high, and that at 300 basis points upon that, and that's the underperformance. I wish we could invest in it, but we can't.
Okay. Thank you, Marcia. Thank you, Governor.
Thank you, Treasurer. Are there any other comments or questions? All right, hearing none. Thank you, Marcia. I believe we are now on item 3 of the agenda, which is investment matters and action items. We're going to go to 3A, which is our committee report. Member Messina, are you ready?
Yes, Governor, thank you. First, let me say I'm only acting chairman of this committee because of Harold's situation, and we look forward to him coming back. Very briefly, we reviewed all of these items that are listed in the agenda for the council to vote on, and we have recommended in favor of each one of the voting items, not all of which are investment items, some are allocation too. But so it was a very productive meeting, and we went over each one of the assets, or the proposed investments thoroughly, and the result was we liked it all, and I want to thank the staff again, and Vince in particular, for finding such good opportunities. It's not an easy thing to do. Thank you, Governor.
Thank you, Member Messina, and thank you also for highlighting Member Lavender's great work, and we all look forward to him getting better. Are we ready then to go to item 3B, which is an action item?
Yes, Madam Chair and Governor, this is Paul Chapman, Director of Real Estate and Real Return. And on the call with me today are Clay Camper and Nino Carpenito from staff, as well as Jack Koch and Seth Marcus from Townsend. And I'll introduce the KKR presenters in a few minutes.
Okay.
At today's SIC meeting, we're going to discuss a potential commitment to the KKR Diversified Core Income Fund. However, before going into the details of that fund and the merits of the investment, we thought it'd be important to vet some issues raised by an advocacy group called the Private Equity Stakeholder Project, which strives to hold private equity firms to account through disclosure of certain activities. Some of you may already be familiar with the tactics of the Private Equity Stakeholder Project, as they've communicated to the SIC on various matters using the public comment section of the agenda. The Private Equity Stakeholder Project recently published some articles related to KKR Energy Income and Growth Fund 2's ownership of a company called Spur Energy. During the Great Texas Freeze-Out around Valentine's Day earlier this year, Spur experienced 18 oil and produced water spills in Lee and Eddy counties. This is obviously unrelated to the Diversified Core Fund that we are presenting today. However, the article seeks to place KKR in a poor light, so we thought it was important to address this before getting into the merits of the proposed commitment. The article makes a number of claims that are applicable to all upstream producers in terms of climate impacts, poor recent returns, and potential adverse impacts on disadvantaged communities. But the claims surrounding Spur Energy spills in New Mexico, of course, are of particular interest to the SIC, and they are particular to KKR. At the recommendation of the State Land Commissioner, who attended the CIC meeting earlier this month, we've asked Ken Melman, who's the global head of public affairs and co-head of KKR Global Impact, to address KKR's responses to this matter, and more generally to comment on KKR's commitment to the environment. Ken is joined by Jesse Audette, Vice President, KKR. After Ken's comments and responses to your questions, we'll come back to Townsend and the KKR infrastructure team to discuss the investment opportunity. So with that, Ken, I'll turn it to you.
Thank you, Paul. Can folks hear me pretty well?
Yes, we can.
Well, thank you, Paul, and Governor and members of the board. Thank you for the opportunity to visit with you today on a very important topic. One of the reasons we are very bullish on the core infrastructure strategy and the infrastructure space generally is how important ESG is to that approach, particularly the environment. And so we wanted to provide a context for what happened with Spur. As Paul noted, we, in much of the country, particularly in the Southwest, faced, let me just first, in case you're not familiar, Spur, as was noted, is an oil and gas business. It has producing assets in New Mexico, and as was noted, we invested through a different strategy in 2019. In 2019, they also acquired Concho Resources New Mexico shelf assets, which was a relatively old oil field. And following the purchase, Spur began efforts to improve maintenance and upgrade the operations. As you recall, unfortunately, during the period of the deep freeze, there were a number of examples where, as a result of the freeze and infrastructure reactions to it, there were challenges. And in this case, there were equipment failures around the deep freeze, and the result was, as noted, some spills. There were 465 barrels that spilled. The vast majority, more than 90%, 467, were produced water, not oil. Where did this happen? It happened in relatively remote locations. The locations were about 2 miles or more from communities where individuals live. The company has a robust effort regarding, one, identifying spills before they happen, second, working to remediate those spills, and three, mitigate potential efforts. And the result of those efforts was the vast majority of fluids were recovered. There was no reported impact on groundwater or on the water systems broadly. And the system that the company has in place, its spill prevention, control plans, and facilities response plans, all being in place, we think were very helpful to that going forward. So obviously this is something that we take very seriously. It's something the company has thought about. It's something the company has learned from. But I think it's worth noting this, as problematic as it was, happened in a remote space in reaction to a very unique event, and there are systems in place to ensure that the effects of that were not felt by communities nearby. If useful and appropriate, I was going to make a couple comments more broadly about our ESG approach, because I think that's relevant to understand how we try to avoid these situations and manage these situations. But I wanted to defer to the governor and the board if that was all right.
Governor, I would like to request that we do just a brief overview of the ESG policy, if that's okay. This is Stephanie. Commissioner and member, I have no objection to that. Are there any objections by the members? Hearing none, let's proceed.
I'll make this very, very brief, recognizing your busy schedule. So with respect to ESG, I think that what's noteworthy is a couple ways that the approach we take as part of our infrastructure strategy and core infrastructure strategy is, I think, a bit different than a traditional infrastructure investor. What are those? First, deep integration of subject matter experts. So we have a global ESG team, a team that will, by the end of this year, have 11 full-time individuals. That team has expertise, not just with respect to how we manage stakeholder issues, but with respect to key KPIs like the SASB standards, the Sustainability Accounting Standard Board standards, that were created to help all investors, asset owners, and companies operate in a way that is more sustainability focused with respect to their operations. The focus on ESG based on these experts is deeply integrated into everything we do. So when we are considering a prospective investment, when the investment committee meets, we work to develop a SASB-based assessment of the particular investment. What are the issues from an environmental perspective, a social perspective, a labor perspective, a community perspective, and are we comfortable with those investments? That's also something that every single company in which we invest will be built into how the board of the company operates, and we have a regular portfolio management committee that oversees these efforts. Second, those efforts are further enhanced by an external network, a network of experts entirely focused on sustainability. So, for example, ERM, which is a globally known consultancy that focuses on safety and environmental issues, is a firm that we often use. Another partner is Business for Social Responsibility, the Environmental Defense Fund. These help us understand not just what's required from a compliance perspective, but what are best practices we can build in. And third, we, through this strategy and through our efforts, are very committed to ensure that these are investments, and the governor made this point earlier, that are consistent with your values and how they operate. So let me give you a few examples. If you invest in our infrastructure strategy today, we provide investors with information regarding Scope 1 and Scope 2 emissions, carbon emissions, that we measure for those investments for our most recent infrastructure fund. In our Going Forward fund, the fund we're speaking with you about today, the core fund, we are committing within this fund to, we think, the right approach when it comes to addressing and ameliorating climate change. What does that include? First, that includes ensuring that as we consider a prospective investment, we look at climate risk, measure climate risk, disclose climate risk with our investors like yourselves using a TCFD-aligned approach. Second, we will continue to measure Scope 1 and Scope 2 emissions. And third, and notably, for this strategy, we will work to develop for each company in which we have a controlling interest a decarbonization strategy, which will help ensure that the companies are operating in a way consistent with the goal of net zero in 2050. All of that will be built into this strategy. And finally, a key component of this strategy is investing in the energy transition, investing in companies that are part of the solution to the challenges of climate change. Today, we're the 9th largest investor and owner of solar assets in the United States. And with our new strategy, the core strategy we're discussing today, we intend to continue doubling down and increasing even further our investment in the energy transition. Would welcome your comments, appreciate the few minutes you gave me today, and thank you again for your time.
Thank you very much. Are there any comments?
Madam Chair, it's Stephanie.
Thank you. Commissioners, please proceed.
Thank you. So, Mr. Melman, I very much appreciate you being here. I did grill our SIC investment staff at our investment committee meeting about just, the questions that they asked you during their due diligence portion of deciding on this investment, and I was very happy to hear that they share my same concerns about really hearing about not only the policies that KKR has invested in, but your response to certain issues that do come up that quite frankly are sometimes out of our control, but it's more important for me to hear the response of a company rather than, sort of excuses about what issues are out of our control. So I do appreciate you being here today to address this, even though, and I'm gonna quantify this, the investment that we are voting on today is not energy related, it is infrastructure related. I still think it's appropriate for us to have these kinds of conversations regarding, any investment company's approach to companies they invest in. So I just wanted to let you know, you may also later on down the line get some questions about the Colonial Pipeline, just because KKR has I believe it's something like a 17% interest in that infrastructure. And right, so I just I wanted to give you an opportunity to just talk. So you addressed your response to a deep freeze, something that's out of your control. Could you address your response to cybersecurity measures and kind of what your lessons learned are moving forward, how you're going to improve those things?
Thanks a lot for the opportunity. It's a hugely important issue. Across everything we do at KKR, as I mentioned a few minutes ago, we look for each company and we say, what are the SASB relevant material issues that company needs to face? So in infrastructure, it's very often safety, it's often health, it's often environmental issues. But in everything we do, we think there are three things that across all of our strategies we need to get right. Diversity, equity, and inclusion is one. The second is being proactive and forward-leading when it comes to climate change. And the third is what we call data responsibility, which gets to your exact point. Cyber issues have to be managed in a thoughtful way, and privacy with respect to companies that possess data. So let me respond to Colonial Pipeline, and then if it's okay, I'll give you just a quick answer on the third component because it's built into everything we do and very relevant to infrastructure. Would that be all right?
Yes, this is the chair. I think it's fine. Do members have any objections to that? I think it's important that we have an opportunity to hear responses to the statements that the land commissioners made. Proceed.
Thank you for the opportunity. So I think based on the recent news of the past several weeks, everyone is familiar with Colonial Pipeline. While you may not have heard about it before, the reality is it's actually a huge operation that safely delivers 100 million gallons daily, $36 billion annually of energy to much of the eastern United States. It's a company that has very much prioritized physical safety and cybersecurity and cyber safety. So to put in perspective, if you look at the industry has an average accident rate of 0.6, and the OSHA accident rate at Colonial Pipeline is 1/3 that number. And so there hasn't been the company has worked 3.1 million hours without lost time injury as of April 31st since September of 2020. It's invested more than $1.5 billion in system integrity and planned maintenance over the last 5 years, and there's been a particular focus recently with respect to cybersecurity. So since 2017, the amount of cybersecurity focus has increased by 50%, and a quarter of the staff now focus on cybersecurity. So what happened? Friday, May 7th, early in the morning, there was a discovery because of the level of focus, because of the level of attention. There was a quick discovery of the ransomware that was occurring. And as a result, the company took immediate action in immediately notifying the FBI and immediately shutting down the system to fix and address the issue. And that's really important. The quick shutdown, had that not happened, what often can happen with ransomware is it can do much greater damage to the system, which would have had a much longer period where energy wasn't available and a much worse effect on consumers and on the economy, etc. There was regular coordination between the FBI, the DOE, and others. In every decision that was made, there was close coordination. President Biden and the White House put the Department of Energy in charge because of the energy issues that are involved. And there is continuing focus today as we speak with not only the investigation, but also with efforts with respect to the government. Certainly going forward, cybersecurity will remain an even greater focus within the company, as it is across our infrastructure investments. So what are the lessons learned from our perspective? The lessons learned are that there's no more important focus than cybersecurity. And to that end, we have created a template for all of our investments, and this will include infrastructure core, of best practices around cybersecurity. What are those practices? First, one component is doing a full 360 audit of everything about a particular company and its potential vulnerability. That includes where the company operates, the industries the company is in, who might be enemies of the company, what controversial things the company's been involved in. Once you understand that, you can then develop a holistic strategy. There are a number of different excellent providers of that service. One of them is a company we actually own through our growth fund called Optiv. Optiv is a company that essentially looks holistically at a particular asset's vulnerability. Then beyond that, a customized approach is to be developed. This is something that we ask to be considered by the boards of our companies, is reviewed in the portfolio management committee of our companies, and like as I described earlier with ESG, will be part of the investment committee process for infrastructure core going forward. Third component, training. 90% of cyber attacks actually are not the result of cyber individuals on the outside only. They're the result of folks like me making a mistake and responding to the wrong email, responding to phishing. And so we also have developed a series of external advisors, including a company we own called KnowBe4, that provides training for employees within those companies. And finally, we also have a program that encourages the purchase of cyber insurance for companies to help ensure that we and you and others as investors are protected in that context. So training internally, understanding risk assessment, regular efforts to penetrate our companies, which we offer those companies and encourage those companies to undertake, regular discussion at a governance and board level, All of these are part of what is a comprehensive approach that we think is one of the lessons that everyone needs to learn, not just from this, but think about solar, wind, and all of these others. We have a similar effort that focuses on data privacy, ensuring, again, if you think about the nature of assets that we invest in, some of them will possess data. How do we make sure they're operating in a way that is protective of that data? And that's another component of it also. Thank you for the time to address that question.
This is the chair. Thank you. Are there any other questions or comments?
Madam Chair, I just appreciate you giving me time to be able to address some of these concerns as they come up. Thank you very much.
I appreciate your diligence, and I think they are important questions and issues to have raised. Are there any other questions? All right, then I believe we are ready for the infrastructure vote, which is item 3B. I have a motion to vote on the KKR Diversified Core Infrastructure Fund?
Madam Chair, this is
Yes.
Member Messina. Based on the recommendations of the Council Investment Committee, Real Return Advisor, Townsend, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve commitment of up to $100 million to KKR Diversified Core Infrastructure Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of the final terms and conditions, and completion of appropriate paperwork.
All right, thank you, Member Messina and Interim Chair. So we have a motion to approve the infrastructure. Yes.
We've yet to hear the presentation.
Oh, I'm sorry. It's really hard to do this over the phone.
So, Madam Chair, this is Paul Chapman. You're on such a roll, and when the governor's on a roll, I didn't want to stop you, but so we have.
Don't worry, Senator Rawson is happy to do it, and that is one of the reasons we like having him on this council.
Oh, okay, terrific. So I'll make a few very brief comments here. We have Townsend on the line, who's done a ton of due diligence on this investment, and then we have a team. Ken, who you heard from, obviously is head of public affairs for KKR, but we also have Tara Davies, who is the head of core infrastructure at KKR. So we'll get to that in a second. But I do want the committee to know that looking at the ability of our managers to incorporate ESG practices into their underwriting is really an important part of the diligence that staff does for you, and it's also an important part of what Townsend does for you as well. I'd like to move from the Spur Energy discussion to the proposed $100 million investment in the KKR Diversified Core Infrastructure Fund. This is an open-ended commingled fund which will pursue investments in utilities. That would include water, wastewater, electric, and gas distribution, communication and digital infrastructure, power and renewable investments, contracted transportation, contracted energy transition infrastructure, and social infrastructure. Now, importantly, on the heels of Ken's comments and the discussion about Spur, the Diversified Core Infrastructure Fund is not an investor in Spur Energy, and it will not fund. The fund will not make upstream energy investments. KKR seeks to raise capital of more than $5 billion initially for the fundraise. They've already closed on roughly $3 billion, including $500 million GP commitment, and they're expected to close another $1 billion by June 30th. They've got the visibility to reach the $4.5 to $5 billion mark by the end of next quarter. The fund will invest in North America, Western Europe, and developed Asia, leveraging their teams in each of those regions. On page 5 of the Townsend cover letter, and this is 87 in diligent, Townsend shows a summary of our core and non-core infrastructure commitments. If you had available to you the weighted average target returns of this portfolio, you'd see that that averages to 10.7%, whereas the projected net return for KKR strategy is 7 to 9%. Part of this return compression is due to multiple expansion for infrastructure investments. But I think of the KKR Diversified Core Infrastructure Fund as a pure core strategy. And you can think of that like our pure Odyssey core funds within our real estate portfolio. While much of the balance of our so-called core infrastructure is more core plus in nature. And I know that Tara Davies from KKR will discuss the specific characteristics of truly core infrastructure investments and the benefits of their open-ended structures. I'll skip over those items. I do want to point out that Townsend has negotiated a very attractive perpetual founding investor fee structure, which is referenced in your materials. However, in exchange, our capital will be effectively locked from redemption for 6 years, by which time it's expected that the fund will have achieved scale. The fee structure will materially reduce the gross to net spread. So I'll stop my comments there. I'll introduce KKR's presenters, Jackie Goodman, who's the director in KKR's Investor Relations Group, and Tara Davies, who's the global head of core infrastructure. But before giving the podium to them, Jack Cope from Townsend will summarize Townsend's recommendation of this commitment. Jack?
Great. Thanks, Paul, and good morning, everyone. As always, it's a pleasure to be with you this morning, hopefully soon in person as opposed to virtually. So as Paul did mention, we are here to discuss a $100 million commitment to KKR Core Diversified Infrastructure Fund, also known as DCIF. This is an open-ended commingled core infrastructure fund that's sponsored by KKR. This is KKR's first open-ended core fund, whereas all of their previous infrastructure funds have been closed-end in nature and core plus and or value add in their strategies. So DCIF seeks to pursue core infrastructure investments with what I would classify as more of a buy and hold approach, which is dissimilar to other closed-end value structures, where in many cases it's a buy it, fix it, expand it, and then sell it. Where in this case, KKR will buy and in some cases improve on the margins, the cash flow, and the operating fundamentals, and then hold the assets to ultimately capitalizing on that steady cash flow generation. So the particular focus in this vehicle will be contracted and regulated cash flows from existing projects. And Paul mentioned in the developed markets of the world, so in North America, Western Europe, and developed Asia. The SIC currently does not have any exposure to KKR within your real return portfolio, but you do have an established relationship with them in your real estate portfolio through your investment in KKR Real Estate Partners Americas 3. The investment in DCIF will be included in the real return allocation and specifically within the infrastructure sub-allocation. So for calendar year 2021, based upon Townsend's investment pacing model, you all have approximately $330 million of capital available to commit across the real assets portfolio. And this would be the first commitment of 2021 within that overall pacing. This is a new open-ended fund that is currently in formation. However, they have acquired 2 assets, which will seed the portfolio. Those assets will require approximately $650 million of fund equity coming from DCIF and approximately $1.7 billion of additional equity that will come from KKR's co-investors and other partners. Those 2 investments, the first is a utility-scale operating renewable energy portfolio. It's comprised of 12 wind and solar assets across the United States. And the second is a 40% equity stake in a regulated electricity distribution business in Finland. So this strategy allows, the primary focus here is acquiring brownfield, operating, and cash-generating assets. However, it does allow for a small piece to pursue development and other greenfield opportunities. The team plans to deploy approximately $1 to $2 billion on an annual basis. That will likely be in 2 to 3 deals, and over a 5-year period, they would reach 10 to 15 investments, assuming that they have deployed that initial $5 billion target raise. As always, we highlight a number of the positive attributes of the fund. In this case, that includes the strong track record, the established team, and the broader KKR platform. In addition to the open-ended nature of the investment structure that Paul referenced, you also have a very well-defined risk guidelines and parameters, and importantly, a very compelling fee structure here. Through Townsend's negotiated aggregation, New Mexico will pay roughly half of what they would have paid on your own, and that will be into perpetuity as a founding investor. So this represents an extremely fee-efficient manner to access this type of infrastructure exposure. Although we do believe that this does represent a very attractive investment opportunity, as always, we outline a number of potential issues and concerns in our recommendations that you certainly should be aware of prior to making the investment. Not to highlight all of them, but just to touch on two. They all are referenced in your recommendation, but to highlight two of those, the first one is the limited core track record. So as I mentioned, this is the first core strategy that KKR is launching. However, many aspects of their other investment strategies are very relevant here and support the investment thesis and their ability to execute within this strategy. So across their three prior infrastructure funds, the firm has raised approximately $11.5 billion in total commitments. They've invested almost $7 billion across 34 individual transactions, and they've realized approximately $9 billion. More than 2/3 of that capital was invested in deals that were sourced through proprietary relationships and or limited auction processes. And I think that's very important as we think about the transition to a slightly lower risk strategy, that they have a very strong acquisitions and sourcing team. They've proven their ability to execute business plans and ultimately exit those assets. So we're very comfortable from that standpoint. Additionally, and as mentioned, this is a new blind pool open-ended commingled fund that intends to deploy, roughly $5 billion over the course of the next 5 years. And so although they've already closed on those two transactions, there is still risk that they won't necessarily be able to raise all of that capital and or deploy it into a very well-diversified portfolio. Now, we do believe it's largely mitigated, given that they are close to closing on roughly $3 billion, and they do have the pipeline and clarity to likely reaching their $5 billion target. Furthermore, the two transactions that have been closed are very representative of what the strategy entails, and both expected to generate a 4 to 6% cash yield in their first 4 years of operation. So it does provide some clarity that they are executing exactly as they plan to. So with that said, I am going to pass the presentation back over to Tara and Jackie to walk through their prepared comments. As always, this has been approved by Townsend's investment committee on a standalone basis, meaning simply for the attributes of the investment strategy, KKR's ability to execute within the overall global macroeconomic environment, and then once again for inclusion in your portfolio, in the SIC's portfolio, given your overall goals and objectives and risk parameters. So with that, I will pass it over to both Jackie and Tara to walk through their prepared remarks.
Great. Thank you very much, Jack, for the introduction, and thank you to the State Investment Council for the opportunity to be here today. I'm Jackie Goodman, and I'm the director in KKR's Client and Partner Group. In addition to my colleague, Ken Melman, who you heard from earlier, I am also joined today by my colleague, Tara Davies, who's head of KKR Core Infrastructure. We appreciate the opportunity to present today on KKR's Diversified Core Infrastructure Fund and very much value our continued partnership with your team. I'm now going to turn it over to Tara, who will provide an overview of our infrastructure platform and our core funds. Thank you.
Great. Thanks, Jackie. Good afternoon. This is Tara Davies, and I'm Global Head of the Core Infrastructure team at KKR. And thank you very much for your time. In the next 5 minutes, I'll just touch on the history of the infrastructure platform and its performance to date. I will spend a bit more time on the Diversified Core Infrastructure Fund and the strategy behind it. And finally, elaborate on the benefits the KKR platform brings to this strategy in what is otherwise a competitive market. So KKR and infrastructure. We have been in the infrastructure market for the past 12 years with dedicated funds and a dedicated infrastructure team. During that time, the team has been led by a gentleman called Raj Agarwal, who resides in the US. And the team, over that period of time, has invested $30 billion in the infrastructure space globally through a combination of co-investment with LP and dedicated infrastructure funds, namely in the Core Plus space. And during that time, we've made 47 investments in infrastructure. In terms of fund performance, our existing funds are of a Core Plus nature, targeting gross 15% returns. So a higher risk, higher returning strategy that exists. But if you look at the performance of the funds, Fund 1 has produced a net IRR, net return to investors of 15.6%, and Fund 2 has produced a net return of 18.7%. So clearly outperforming the targets that we've set for our investors within that strategy. The diversified core strategy, as mentioned by Townsend, is a new strategy. And what we're trying to achieve in that strategy is to genuinely match long-tail liabilities with long-tail assets in an open-ended fund structure. And really what we're seeking to do is buy simple infrastructure and hold that simple infrastructure. So never needing to actually monetize the assets that we're investing into. However, given the open-ended structure, our investors will actually be able to have liquidity by recycling the units that they will have in the fund. And so beyond the lockup period of 6 years, you will be able to get liquidity in the fund despite the fact we have a strategy to buy and hold those assets. The fund is very much focused on diversification. And I think if COVID taught us one lesson, there were winners and losers by sectors within the infrastructure space. And so we do feel that having a broader range of sectors will reduce the volatility of returns over time. And that's exactly what we're trying to achieve in a low risk, lower returning infrastructure product. And so as mentioned, you will see renewable energy investments, you will see regulated utilities, you will see contracted telecom, social infrastructure procured by public-private partnerships, and you will see things like district heating, which are facilitating an energy transition agenda. The assets themselves will have a revenue model that's largely regulated or contracted by nature. And the businesses that we're investing into will be very asset intensive. So this should lead to EBITDA margins above a 50% level, and that should lead to high year-on-year cash flow generation. So broadly speaking, one will expect 50% of your return coming from average annual cash yield and 50% of your return coming from things like indexation or GDP correlation. We have two seed assets in the strategy, one in the renewable space, one in electricity distribution. And we've just announced a third deal in the public-private partnership space on a global basis. And just for avoidance of doubt, I think as mentioned, it's not the intention of the strategy to invest in upstream oil and gas or coal. And actually, given the longevity of the strategy, we are very focused on being on the right side of a carbon neutral environment in 2050. And we are taking that actively into consideration as we're focusing on asset allocation for the strategy. I'm cognizant we do exist in a competitive market position, and there are a few facets of the strategy that we believe uniquely place us to value create for our investors. The first is alignment. We are investing $500 million from the KKR balance sheet in this strategy. So we are very focused on value creating here. As an investing team, we will be investing in the fund. So this will be my pension as well. And we invest in our own deals, and the assets stick with us as investors. So that does focus the mind on the deals that we're prepared to do and the deals we're prepared to walk away from in a competitive market environment. The second element is corporate sourcing. If you look at the infrastructure track record, over 60% of our deal flow has been created from our relationships with corporates. And if you look at where the infrastructure assets sit within the market, today over 50% of the infrastructure assets globally still sit within corporate hands. So that is very fertile hunting ground for new investments. We like this strategy for sourcing because we do genuinely find these are our ideas, so there's less competition in and around those situations. They're heavily negotiated deals, which provide us with more downside protection and better risk return. And we've had a track record of facilitating repeat deal flow with corporates. And then finally, I am very privileged to sit on the KKR platform. And that platform is a very powerful tool for me to prosecute new investments and value create. For example, we have the ability for the balance sheet to bridge to a co-invest for LPs, which gives us pace when we're doing deals. The Capstone team, our operating team, provides us with value creation opportunities so we can really increase that yield for investors. So that platform effect is very much available to the diversified core infrastructure funds to ensure that we're focused on performance mattering. I'll just pause there and check to see if you have any questions.
Thank you. I appreciate that. Members, do we have questions? Okay. Hearing none, continue, please.
Madam Chair, this is Paul Chapman. I think perhaps it's appropriate to go to a vote now. Tara, am I cutting you off from anything that you were hoping to communicate?
No, that's fine. Thank you.
Thank you very much. And Paul, thank you. See that those kinds of cues when people are done is helpful. Do we have do we redo Member Messina the motion to approve a vote for the infrastructure investment up to $100 million? Do you want to do that again, please?
Yes, let me repeat the motion. Based on the recommendation of the Council Investment Committee, Real Return Advisor Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve commitment of up to $100 million to KKR Diversified Core Infrastructure Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you. Member Messina, do we have a second?
I second that. This is Nick Tejas.
Thank you, Member Tejas, and thank you for telling me who it is. I appreciate that. Do we have any questions, concerns, comments on the motion and the second?
Madam Chair, this is Tim. I apologize. I couldn't get off of mute quick enough to ask a couple of questions prior to the motion.
No, I think it's fine to do that during the motion, and thank you very much, Mr. Treasurer. Please proceed.
Oh, thank you. Paul, I don't know if this is for you or from somebody else, but on the executive summary on page 92, the last bullet where their Project Supernova, I was just wondering in their Finland investment, is any of that energy going to be renewable?
That'd be a good question for Tara to take.
Sure. Thank you very much for that question. A large proportion of energy is transitioning to a renewable base in Finland. And in Finland, the major source of that is hydro. So there will be increasing renewable energy in terms of source of electricity going through that network.
And Paul, you mentioned briefly the fee structure. And so I guess this question was more for you, because I looked at page 93, and then I looked at page 110, and I kind of penciled out what I thought the fee structure was, which was like 60 basis points. But could you kind of spell it out for me? Because I'm totally confused.
Okay, we typically try not to discuss the specific fee structure in a public forum, but let me just point you to page 93 where it says standard management fee,
Right.
and go to the column that says perpetual founding investors. Look at the bottom number in that column.
Okay.
And that will be our fee. And the reason for that is because, and I think this might be unprecedented, Townsend has raised $1 billion or more towards this fund. And because Townsend negotiated a discount based on aggregating all their clients together, we get quite a dramatic fee break. Just by comparison, as Jack said, that fee would typically be double for a core real estate strategy or a core infrastructure strategy.
So I even thought my guess was extremely good. So I was very happy with that. On page 110, when I started looking at those numbers, I noticed that the founding investor round, the deadline has passed. Did they extend that to June 30th?
Yes, they did.
Okay.
And Evan Land will kill me for trying to get him to close a deal within a month here, basically. But sorry, Evan.
Thank you, Paul. Thank you, Governor.
Thank you, Mr. Treasurer. Do we have any other questions, comments? All right, I'm going to call for the vote. All those in favor of approving the up to $100 million for the infrastructure fund investment, say aye. Aye.
Aye.
Do we have any opposed? Any abstain? Thank you, everyone, for your patience with me. Thank you for a thorough presentation and the questions. The motion is approved.
Thank you, Madam Chair.
Thank you very much. Absolutely. Congratulations. All right, we are now on item 3C, which is another action item. We have an app allocation, and we're going to go to RDK and, of course, Smith again. I don't know who wants to go first.
Thanks, Governor. I'll start with just a few broad comments on this, and then RVK can take you through some of the details of the work that we've done. Every 3 years, we formally review the asset allocations of the permanent funds. In this case, we have land grant and severance that we're looking at today, but also the newer fund, the education fund. We'll be reviewing that asset allocation. I think we've discussed these extensively with the CIC and received their approval and recommendation to the full council. I think what you'll see in here as we move through them is two major themes playing out this time for the review. First is to maintain our very diversified orientation in the asset allocation of these funds. And as we talked a little bit earlier, we're at just about our maximum point of diversification in these funds. We'll talk about that as we go. But the environment that I think we'll be facing over the next several years, and you'll be seeing more on this next month when we do the annual investment plan, is one where we likely will see some rising interest rates, particularly on the short end of the curve as the Fed normalizes Fed funds policy. We're likely to see the withdrawal of the extreme levels of monetary and fiscal policy we've had over the last year, and in fact, high levels of monetary policy over the last 10 years. And we'll see normalizing valuations on our risk assets, particularly stocks, but we also will see some normalized valuations on bonds likely as interest rates rise a little bit. We think this will feed into lower rates of return in total, and we also think it will feed into increased bouts of volatility in the portfolio, particularly in stocks. Second, there's a new potential risk facing us, and we've mentioned this a couple of times in the past couple of months, is potentially an environment of greater inflation
which would be a trend change from the last 4 years. So we've had inflation falling for 4 years now. The great inflation of the 70s was finally broken in 1980, 1981. And since then, we've had just a downtrend in inflation over time. So this is a new risk that's facing us, is perhaps a reversal in that process. We think the current inflation we're seeing is a little bit transitory, but when you look over a little longer period, and we'll discuss this in the annual investment plan, when you look over a little longer period, that 7 to 10 year period we use, we think that's a risk that's facing us. So we think it makes sense here to keep our risks down a bit, our investment risk down a little bit. We think it makes sense to do that through diversification rather than just removing risk assets from the portfolio. So at present, we own a wide range of assets, and we try to source return from as many areas as we can. There's no relatively large investment in any one asset class. If something went wrong with one of our assumptions that would unduly damage the portfolio. For example, the largest exposure we have is in the stock market, which is a 40% weight. But traditionally in this fund and in funds similar to ours, exposures to stocks typically run 50 to 65%. So quite diversified at present. And I think what you'll see in these recommendations is to maintain that diversification. We've got a couple of tweaks that will help with the implementation of the asset allocations, but no real big change, and just sort of continuing on with the strategy we've had for the last few years, at least in terms of being broadly diversified and trying to hold our risk down a little bit. The second piece of this will be the Early Childhood Education Fund. Here we took a very conservative asset allocation up front when the money first came in. We really wanted to discuss with all the stakeholders what it meant to hold a tight portfolio for this fund, and that's what we need based on the expected distributions from this fund. This fund needs to be in growth mode, but moving it into that has risks. There will be volatility risks. If stocks fall like they did a year ago, we can see losses in this portfolio, at least unrealized losses in this portfolio. So we wanted to be sure we could discuss that with all the stakeholders. We did so. We think folks have a good understanding of what it means to be in a risk portfolio. This portfolio over time will look a lot like the land grant and severance tax do in terms of its asset allocation. But rather than just putting the pedal to the metal right away and moving to a full growth portfolio, we want to take a little bit more of a conservative approach here. We've talked this through with the Council Investment Committee, and they're in agreement. So what you'll see is sort of a half step between the low risk portfolio we're currently in and a full growth portfolio that you see with land and severance. We think that makes the most sense in the market environment today. Certainly, we'll look in subsequent periods to move that to a full growth portfolio. But for now, we think it makes the most sense to move a little bit slow in getting there. So with those preparatory remarks, Governor and Council, let me turn over to RBK, and they can work you through the report itself, and certainly have any discussion that you would like to have.
All right, thank you.
Okay, great. And thank you, Madam Chair. It's nice to have you with us today. Thank you, Vince, for these introductory comments. I think we'll pick up on page 155. That's the introduction to the asset allocation studies. And most of you have seen this type of work before. And it's really built on the capital market assumptions that we develop annually and that we reviewed at the March meeting that provide us the type of guidance and foundation to be able to evaluate the risk and return trade-offs with potentially different asset allocation approaches to each of these funds. So this is a helpful tool, but it is just a tool. And so there's been lots of conversation and dialogue along the way that helps inform that, but it is a nice quantitative way to supplement that discussion. The other item that usually can be derived from this type of exercise is getting a better understanding whether there are potential enhancements to the strategic asset allocation, so there's a policy weight, not just the asset classes, but the weightings of those asset classes, and then also some forward guidance on the probability or the likelihood of achieving certain return targets. That has multiple implications in terms of intergenerational equity, in terms of spending sustainability, so on and so forth. So it's good to understand whether you have high or low or reasonable probabilities of meeting your return expectations. So we'll talk a little bit about that as well. As Vince mentioned, we have three funds that land grant severance, of course, as they're your flagship funds, and then early childhood, given the need of likely more substantial changes. I will just sort of preview by saying land grant and severance are efficiently allocated and very diversified, not susceptible to any particular risk, as Vince mentioned. So there it's more refinement on the margin. Early childhood, I think you'll see more substantial changes. So starting on page 156, we'll have land grant for you, and not a lot in the way of low-hanging fruit. We talked about the very difficult capital market environment where most asset classes are expensive, at least relative to history. And lots of folks are recognizing these risks and pursuing asset classes that may have marginally higher levels of expected return, which then, of course, brings down that return expectation as more money is piling into those opportunities, or more dollars are chasing the same or fewer opportunities. So there's not too much in the way of let's say a free lunch, but there are certainly some opportunities that we're looking at. And I think that's helpful to keep in mind, as particularly as we talk about early childhood and the shape and the slope of the efficient frontier in terms of where you want to be on the risk spectrum as well. On page 157, you can see just the year-over-year change between expectations for land grant. So in blue was land grant as of first quarter last year, and you may recall that we actually did something we hadn't ever done, which is reissue our capital market assumptions at the end of the first quarter. Typically, they're done using year-end data, but there was such a big change at the onset of the pandemic in terms of forward expectations after the bottom fell out of the stock market in particular, that we felt compelled to give it a fresh look, because the numbers just were no longer accurate. Now, as a result of that, the numbers, the expectations, because of the drop in the stock market, increased quite materially coming out of that. And I think the recovery that we've experienced has exceeded most anybody's expectation, not just in terms of the speed, but also the magnitude, now that, of course, we're at new record highs for a number of asset classes. So that's something to bear in mind. And given those strong returns that we looked at when we discussed the executive summary and even your own results, but also the markets more broadly, we had to right-size these forward expectations. And so in some ways, we've borrowed some return from the future, and that in some ways is going to moderate long-term returns on a forward basis. So because of that, you'll recall that capital market expectations, and we're not the only firm, most large organizations, whether it's consulting or asset management firms, produce some form of capital market expectations, and they've all come down because it's hard to escape these realities. So we should moderate our expectations in terms of what we think we can earn over the intermediate to long term. And I think that is helpful context to consider that. On this page, in the red box, you can see the change in return expectation for the compound return. So that is the risk-adjusted return measure that factors in how much risk you're taking and on top of the average return. And you can see about a 70 basis point or 0.7% decrease from last year. Now, again, this is over a long time period, but fairly substantial reduction in expected return going forward. That's one item that's quite noteworthy. In the section right above that, where you have capital appreciation, preservation, all the way down to inflation, those are your thematic exposures. And as Vin said, it's fairly diversified. With about 70% of your assets part of the quote-unquote growth engine that is designed to generate returns for you. You do have the ability as a perpetual fund to take on a good deal of illiquidity in order to generate more long-term return, or at least improve your probabilities. And so that is certainly wind at your back that not all other funds have, and something to be mindful of. At the very bottom, the last three lines, you'll see the estimated annual yield. You'll notice that the yield has compressed quite a bit as well. Last year, actually, the yield was about 60% of your total return expectation. This year, it's about 2.5, and that percentage has decreased to 40. So there's more variability in terms of what your actual return experience might be. The last item I'll point out is the very last line, which is the probability of meeting your target return over the next 10 or so years. And you can see that last year was 48%, again, coming out of that pandemic-induced sell-off in the market. So better expectations coming out of that now that we've earned a lot of that back and had some very strong numbers again. But the forward return target is actually quite a bit lower, down to about 41% probability of achieving the 7% return target. So something we'll look at more closely as we advance through these slides. I'll just pause there briefly to see if there's any questions so far.
Thank you. Do we have any questions or comments so far? All right, hearing none. Proceed.
Okay, perfect. 158 shows you similar information, but also shows you the range of opportunities. So portfolios 1 at the top, all the way through portfolio 10. That is essentially from most conservative to most aggressive, within the confines of some asset class constraints that we have in this model to produce portfolios that are actually realistic and investable. For example, it's an extreme example, but even if you were very, very positive on private equity and wanted to put 100% of your assets in the private equity, that's not realistic, nor would it be achievable in any reasonable amount of time. So we have to put some constraints on this model, and as a result, these are some of the outcomes. And you can see that there's some variation, but it is somewhat limited. On page 159, you see that visually. It's probably more helpful. The top line is the actual model in arithmetic terms. And what you'll notice is a couple things. Obviously, if you want to generate more return, you have to take on more risk. And that is the case. And as you look at the first 5 portfolios or so, you see that the slope is quite steep, that you're getting quite a bit of additional return for just a bit more of risk. So you're going up and over about the same proportion. And then it starts to flatten off. And what that essentially means is that as you're seeking incremental return, you have to take exceedingly more risk in order to generate that. So there's diminishing returns there, and additional risk taking generally isn't rewarded. Now, when you take that and convert it into risk-adjusted space, which is the dotted line below that, you can see that really from 8 to 9, no difference, and then from 9 to 10, so going all the way out, it actually turns over. So the amount of additional risk that you assume in risk-adjusted space actually overwhelms just a little bit of potential additional return you can get. This is all to say, and again, we'll look at it when we go to early childhood, this may not be the best time to just go pedal to the metal and load up on the most risky assets. Page 160, and I'll be a little bit more detailed on this first step for land grant, just to give you lay of the land, and then the subsequent two funds will go a lot quicker because the pages look similar. So page 160, this is the Monte Carlo or the stochastic analysis saying, look, we understand that these assumptions aren't always going to be exactly right. There's some form of variability, and this model, the stochastic model, builds that in. Over shorter time periods, there's quite a bit of distribution of outcomes. So you can see that the very first line is the first probability over a 1 year basis. Another way to think about that is your max drawdown or median value at risk. And you can see the land grant has somewhere, and again, this is not necessarily what the fund would stand to lose, but just in this particular model, comparing it to other potential portfolios, about a downside of negative 32%. Portfolios 9 and 10, which are adjacent to it, have a downside of negative 33 and 35%. So more downside, despite not really having any better long-term return prospects. And you can see that at the third line from the very bottom, which is bolded, that's the 10-year 50th percentile. You can see that those portfolios 9 and 10 are expected to return 6.2 and 6.1 versus land grant of 6.2. So no better long-run expectations, but a higher chance of losing more or at least having more of a substantial drawdown. So one observation there. The other is that over a 10-year period, you even under fairly negative capital market outcomes, you have a very low probability of having a negative return. So you can see that even the 5th percentile is just barely negative. That's also, well, not a good result. It's somewhat encouraging to know that over time, things will tend to work themselves out. Page 161, this shows the probability of achieving certain return targets. We talked about land grant having a 7% return target and how achievable that is. You can see at the very bottom, or the second line from the bottom, it's bolded that 7% return target, currently a 41% probability. Ideally, we would be at 50. If you slide up in that column a few lines, you can see 43, 46. So you're getting closer to 50, and probably somewhere in that 6.5 to 6.25 under current expectations is where you get to 50. Now, you don't have to always be at 50, but if year after year expectations are that you're going to fall short, then you may need to right size or adjust your target return. The other item that I would note next to that 41 is that you slide across from right to left on that line, you see that there's no portfolio here, even portfolio 9 and 10, which are sort of more pedal to the metal, that is reliably expected to generate 7%, or that gets you that 50%. So it's not necessarily an asset allocation issue or something that can be addressed or fixed through asset allocation, outside of really swinging for the fences and being willing to take on substantially more risk and having substantial volatility around your outcomes, which again has some implications on distributions and spending and intergenerational equity. So it's not a singular or a decision that can be made in a vacuum. But it's all to say that there is no alternative allocation that doesn't come with its own set of risks that could get you to 7% under these current expectations very reliably. So I think that's a point worth noting. So that's the current lay of the land of land grant. I'll stop there before we move on to page 162.
All right, thank you. Any comments, questions, concerns so far? All right, I think we're on to the land grant.
Okay, perfect. So on page 162, and this will start going a little bit quicker here. Here we're looking at the actual recommendation for land grant, which is a reduction of real returns. Now, we've considered lots of changes at the staff level, even with the CIC, more changes, but ultimately ended up at this particular point in terms of the recommendation. None of the other items that we looked at really had a material impact or materially improved it. Now, this reduction of real return is not intended to materially change the portfolio, but is a better alignment of the actual implementation and the opportunity set for this portfolio. So as you looked at current allocations versus the target, you probably noticed that it's difficult to scale up real returns to the target allocation, and generally the returns probably falling short of expectations. So right-sizing that or bringing the target closer to the current allocation without stretching and trying to find opportunities that may not be the best risk-adjusted return opportunity isn't in the best interest of the fund. So the recommendation here is a 2% reduction in real return. So as you compare the green and the blue columns, you'll notice that they're almost identical until you slide down to real return, so from 12 to 10. And that 2% return reduction would then be made available for private equity, so the National Private Equity Program, where opportunities may either be more compelling or more plentiful. So that is the recommendation in terms of changing the asset allocation. The results on the portfolio are not particularly substantial. As you look at the three bolded lines, you can see that they're almost the same, and the compound return, the third line, is 6.0. So for both portfolios, not a huge or meaningful change, but one that, from a portfolio management perspective, could be a much better alignment, at least for the foreseeable future. The next few pages show it to you visually. Page 165 shows you the stochastic analysis. Again, with the variability, you'll see that the downside on page 165, the first line is essentially the same. The 50th percentile at the third line from the bottom is 6.2. So this change doesn't impact the long run expectations in a material way, nor does it change the overall risk profile in a material way or in a way that would be concerning. 166. Maybe I'll just point that out, because it doesn't change it. It also doesn't materially improve the probability of achieving the 7% return target. You can see it improved 1 percentage point, but that's rounding within this type of a model. So I wouldn't read into that too much. So essentially the same. Doesn't solve for that return gap, if you will. Speaking of return gap, 167, you can see that and how the return expectations on a forward basis have evolved over time. The orange line is the return target, and you can see that historically it was at 7.5, but it's been at 7% for quite some time. And that green line is the arithmetic, so the average annual return expectation for each of those years on a go-forward basis. And you can see that it's been tracking fairly closely with the return expectation, so with the orange line dipping down at the end of 2020. Again, just given valuations. Then we had the pandemic-induced sell-off, which resulted in better expectations, so it shot back up. And now with the very strong returns we've experienced over the last 12 months, essentially, it's decreased to an all-time low, and so that gap has increased. The blue line is that number in compound space, so risk-adjusted space, and you can see that there's been a gap all along. I think there's been some comfort around having a difference so long as the average annual is close, but I think it is noteworthy that this is now the second observation, essentially, in a fairly short period of time where expectations have fallen below. So this may warrant some further conversation at a future meeting, so I just wanted to address that in a little bit of detail. That concludes land grant, so I'll pause before we move on to severance.
Any questions or comments about land grant? All right, proceed to severance.
Thank you, Madam Chair. Severance will pick up on 169, and I'll probably just highlight differences to facilitate this review as it pertains to land grant. And so you'll see similar allocations for severance, similar trend lines in terms of lower expectations. The biggest difference from an allocation perspective, as many of you know, is the in-state private equity program for severance. That's grown somewhat over time, and it's a 9% target here under the current policy allocation, with 3% in the private equity. The three bolded lines again show you the total portfolio results. You'll see that year over year there's 60 basis points or 0.6% lower expected return. And that return is actually 40 basis points lower than land grant. And so that primary difference is the lower return expectations for the in-state program compared to the national program for the time being. The other item that is different is the return target, slightly lower, 6.75 compared to 7% for land grant. And the very last line here is the probability of meeting that 6.75% return target, and you can see that there it decreased from 45 at the end of the first quarter last year to 38, so just a bit better than 1 in 3 chance of getting there. So even though there is a lower return hurdle or target, the probability is actually lower than it is for land grant. Pause there for any questions.
Any questions, members? All right, we're on track.
Okay, great. Maybe I'll skip to page 171 and just point out that under the current exposures and constraints, the policy allocation that you have is right on the efficient frontier, so it is highly efficient, and no concerns there. We talked about on page 173 the challenges of meeting the 6.75 over 10 plus years, 38%. And you can, there as you slide up in that very right hand column at the bottom, you can slide up from 38 to 41, 44, 46, 49. And you can see you get closer and closer to 50. And as you get closer to 6% and maybe even 5 and 3/4, you can see that that's about where the 50% mark is in terms of return expectation. Now again, we'll look at this in more detail in just a few slides. These numbers can change from year to year, but I think there's certainly a trend of as valuations continue to be elevated, that returns are going to be challenged. So that's I think an expectation that will stay with us for quite some time. On page 174, now we're transitioning into the recommendation actually for severance, and it's identical to land grant for all the same reasons, which is a reduction of real return by 2% that helps solve some of the allocation changes, and also in this case have a better balance between the private equity exposure. So as you look at the green and the blue column, you'll see a 2% from 12 to 10 reduction in real return, and a commensurate increase to the private equity program from 3 to 5. Now that's the national program, and so currently at 3%, the national program is targeted about 1/4 of the overall private equity exposure. This would bring it to about 1/3. So a little bit better balance there, and again, probably better opportunities in terms of allocations and investment strategies compared to real return. Similarly to land grant, no meaningful change to the expected outcome, either on a long run median basis or on the extremes. You can see the compound return is 5.6 for both. So no big change there. And on page 177, I'd like to see that no meaningful difference to the downside risk or the long run return expectations. So we felt that this is certainly very reasonable change to consider. Page 178, same comments. It doesn't solve the return gap that we've identified and highlighted. Doesn't get you really any closer, and probably still want some conversation as we continue to have these meetings and these discussions. Page 179, you can see that historical expected return compared to the return target there. You can see it actually decreased even more than it did for land grant, down to 6 3/4, and has been at that level for quite some time. But the green line is actually shot below the orange line, even at the end of the first quarter, despite the increase. And you can see the line chart there picking up on the second to last data point. It still wasn't enough, and those were under very, very optimistic capital market environment and forward expectations. Even then, it fell short of that 6 3/4 target. And now with 2021 expectations, even further. And that's on an average annual. By the time you factor in risk, which is the blue line, you can see that the gap is even lower. So I think land grant, there's some value in continuing to have that discussion, but for severance, it's probably even more relevant, given that the gap is wider. So the same recommendation for land grant and severance, 2% reduction in real return with a commensurate increase to the National Private Equity Program. And I'll pause there before we chat a bit about early childhood.
Okay, thank you. Any responses?
Well, this is Lee. I have one quick question on the assumptions.
All right, thanks, Senator. Please go ahead.
Could you go back over, or maybe I missed it, on the assumption of, it seems like we're assuming that the risk reward for the international is going to be the same as domestic going forward over this period. Is that my understanding of what you're saying?
Thank you for the question. And this is for public equities, domestic and international equities.
No, just public equities, right?
Public equities. Okay. Yeah. Well, absolutely. So the return expectation is on a go-forward basis is actually higher for international. Now, international also has a higher risk expectation compared to U.S., but the return expectation is higher. So by the time you factor those together, risk-adjusted return expectations are actually quite a bit higher for international equity, just given the run-up in valuations domestically. We haven't seen quite the same in the international or broad international market. So another way to think about it is the Sharpe ratio or the risk-return ratio expectation is higher for international equity, and it's not to say that that's going to flip, tomorrow or next week. But just like we've been in a period where growth has outperformed for quite some time, we've now started to see value doing a bit better. These things tend to go in cycles. The U.S. or domestic versus international also tends to go in cycles, and we've been in very prolonged cycles for both of those particular trends. But at some point, valuations are going to have to matter here.
Thank you.
Yeah, you bet. Appreciate the question.
Thank you. Anything else? Okay.
Okay, great. Page 180 takes us to the early childhood, and Vince gave a great introduction in terms of this fund being a newer fund. It's relatively conservatively invested, has a focus on income, liquidity, downside protection. At least those are some of the high-level characteristics that come out of the allocation that it currently has. But long term, this portfolio likely is better structured with a growth focus. The big question is, given all the things we've discussed this meeting and in prior meetings about capital market environment, is the right time to go pedal to the metal and to try to scale this thing all the way up to look something like land grant, or should there be some form of a half step or incremental step to risk that up? There is some timing risk, of course, and the valuations are rich. That risk is elevated. So I think collectively and in discussion with the investment committees, there was a general consensus that a half step made sense, and then we talked about what that half step might look like. So that's the high-level introduction. On page 181, you can see the current exposures of early childhood, and again, it's all conservative, either fixed income or bond proxy life, high levels of income, not much in the way of volatility or risk, and it's a very efficient allocation, but not one that necessarily earns a lot of return on top of inflation, and certainly not one that's going to materially grow the fund. So that is the lead into that. On page 182 and 183, you can see the current exposures and constraints. On 183, as you look at that, you'll see that those two lines, which were quite a bit apart from one another in the other two funds that we looked at, here you see that they're relatively on top of each other given the conservative allocation. So there's not enough risk there really to materially alter the return expectations, but you're also on the very low end of the return scale, if you will. So trying to find that right balance is where we spent a good deal of time on, and the investment committee and other council members that participated were quite helpful in providing their feedback and guidance. So you can see that on page 186, where now we look at a broader efficient frontier that has asset classes more aligned with a growth allocation. You'll see the introduction of asset classes such as public equities, and then also items like private equity and real return items that were currently not found in the early childhood, which is the green column. And again, see what that is currently invested in. We also added the land grant blue just as a reference. So those are essentially the two stakes: early childhood, very conservative; land grant, probably as far out as you'd want to go. And then the question is, where in between those two do you want to end up? We considered a number of portfolios internally and with staff. With SIC, we looked at 6 and 7, portfolio 6 and 7, and then ultimately the preference of the committee was portfolio 7. That's why it's in the red box highlighted for you there. And you'll notice that as you look at those allocations, particularly for equities, you'll see that you have essentially a half step to those particular asset classes. So it's an incremental step, particularly in the most richly valued asset classes. And when you look at the bolded lines, the 3 bolded lines towards two-thirds of the way down, again with compound return and expected risk, you can see that it's about halfway, a little bit more than halfway from early childhood to land grant. So an incremental step that may give you the opportunity to essentially dollar cost average into some of the more at-risk asset classes. See if there's any questions.
Are there any questions from members? All right, I hear none.
Are we ready for a vote?
It appears to me I'm going to just double check given these mistakes, and thanks for everyone's patience. Is that the end? I counted all the pages and funds, but is that the end of your presentation?
There's a few more, but I think it's sufficient. If the council's comfortable, I'm certainly happy to end my comments here.
Well, let's make sure. Is everyone confident that you have the information? It appears so. All right, let's proceed with the motion.
Thank you, Governor. With respect to each fund, the recommendation is to move, with respect to asset allocation, 2% from real return and add it to private equity, as I understand it. And that's true in each, although the numbers are slightly different, it's true in each fund. So I'll make one motion covering all three. Based on the recommendations of the Council Investment Committee, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve the updated asset allocation for the Land Grant Permanent Fund, the Severance Tax Permanent Fund, and the Early Childhood Education Fund as discussed with you and memorialized by the Council today.
Thank you. Do we have a second on the motion?
I'll second, Governor. Not Bingaman.
All right, did we get that? I didn't hear who that was. Who was that?
It was 154 or something.
Okay, wait, we may need a mute. Who was the second?
Sorry, this is John Bingaman, Governor. I was offering to second the motion.
Oh, thank you, Mr. Bingaman. I couldn't hear you. I knew it was, all right, thank you very much. We have a motion and a second. Any discussion on the motion to approve? Hearing none, call for the vote. All those in favor say aye. Aye.
Aye.
Any noes? Anyone abstaining? Hearing none, the motion carries. The asset allocation change is approved. We are now on, Mr. Messina, item 3D. It is the contract terms recommendation. Mr. Smith, you want to take us through this?
Thank you, Governor. I'll certainly do that. So on page 195 of your diligent book, you'll find a memorandum from me describing a recommended change to our contracting terms. As you know, we presently contract with for investment management agreements with our managers on a 4-year basis, and these are primarily publicly traded strategies, so stocks and bonds, the primary strategies that are involved here. We presently contract on a 4-year basis. Those management agreements then expire at the end of 4 years if we don't, re-up with those managers. Always, we extend these contracts. I look back, I couldn't find any. There may be one I missed, but I couldn't find any that we allowed to expire and end that particular strategy. Almost always, we use a 30-day. All these contracts have a 30-day out for us. So with 30-day notice to the managers, we can terminate the strategy. That's almost always how we exit a strategy. So what the recommendation involves here is just simply moving to a 1-year automatically renewable contract that we still have a 30-day notice clause in to exit. So we would continue to exit these contracts as we have in the past on our 30-day notice, but we wouldn't be at risk of a contract expiring unnoticed by us or the manager. So it takes some risk out of our current contracting terms, but doesn't hinder us on how we typically get out of these contracts, or doesn't take any flexibility away from us to manage these things. Just simply takes some risk out of the system. So that's the recommendation in a nutshell, and can take any questions that you have.
All right, members, do we have any questions or comments?
This is Lee.
All right, Senator Rawson.
So, as I understand it, we're just going to go to basically an evergreen type contract rather than a fixed period. And my concern on that is where the council will no longer have the opportunity to weigh in on that or really be informed. So if we're going to do this, it seems that we need to have some reporting back to the council even though we might not miss the deadline, we might be after the deadline, but at least there needs to be some sort of reporting.
Right. So we discussed this in the CIC. Member Rawson and Member Tejas and I are going to work together to come up with a reporting format. Hopefully, we'll be able to arrive at that shortly, and I can present that to you next month. But it would be just at least an annual review of where we are on each of these contracts. And the idea is really just to not let language get out of date, because Evan periodically updates the language that he likes to see in these contracts. So we don't want that to come out of date on some of these longer term ones. And also to be sure we're monitoring the terms of the contract, in particular fees. If fees start to fall in a particular area, that we're able to track that down within our contract. So we're working on a format to be able to report exactly what you're asking about here.
Right. I just don't want the council to be left in the dark here. All right. Thank you.
Thank you, Senator. I agree, and I don't think that needs to be more perfected or formalized, given that we require regular reporting, but I don't want it to get lost either. Agree with the senator. Are there any other comments or concerns? All right, hearing none. Member Messina, do we have a recommend? Okay.
Yes. Governor, based on the recommendations of State Investment Council staff and the general fiduciary oversight of RVK, I move that the State Investment Council approve that expiration terms on investment management agreements and other contracts deemed similar in nature be shifted from fixed expiration terms to a 1-year automatically renewed term as discussed, reviewed, and memorialized by the council today.
Great, thank you. Do we have a second on the motion to approve?
Madam Chair?
Yes?
This is Lee. I would like to see that motion amended to include with reporting to the council annually.
I'll second that. Is that the commissioner?
Cassidy, yes, I'm sorry.
Okay, great. All right.
I'm glad to amend the motion as suggested.
All right, so it's a friendly amendment. It has been accepted by the acting chair. And are there any discussions, comments, or concerns about the accepted so far friendly amendment to the motion, which would include reported requirements, if so approved? Okay, hearing none, the motion is amended to friendly amendment, and now we need a second.
I'll second it.
This is Kathy. I'll second it. Okay. And do we need to reread? I'm confident and comfortable that it will get recorded as such. Senator Rawson, do you need a rereading? Even though we've got a second, I just want to make sure I don't gloss over this particular action.
No, I'm good, but it's hard to do voice votes. It's almost better to do roll calls, but it takes more time.
Objections or any nays, I might do that, but I appreciate your constructive feedback, Senator, always. All right, without any further discussion, I'm calling for the vote. All those in favor of the change contract terms recommendations, including required reporting, say aye. 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 Any nays? Anyone abstain? All right, the motion carries. The contract terms recommendation changes are approved. We're now on item 3E, which is the intergenerational equity update, and we're back to you, Mr. Smith.
Great, thank you, Governor, and thank you for that approval. That'll take some risk out of our system. That's always welcome. On this item 3E, you'll find a report in your book. Annually, we update you on the intergenerational equity status of the land grant permanent fund and the severance tax permanent fund. And we are here before you today to do just that for 2021. As you recall, intergenerational equity is just a fancy term for balance. balance in terms of the distributions from the funds between the current generations and those who will follow us. How do we go about attempting to monitor this balance? Well, shift to page 197 in diligence, page 2 of the report, and on the left-hand or right-hand side of the page, you'll see a pie chart. These are the three components that we monitor to monitor the intergenerational equity of the fund. So what's our contribution policy? And that really for land grant is the inflows from the land office. For the severance tax, it's the inflow from severance taxes. What's our expected, and what are they expected to be in the future? What's our expected rate of return for the portfolio or returns on our investments? That's the bottom piece there. We combine all these into a rather extensive financial model, and we can make some estimates based upon assumptions about those three things, about how balanced the fund is in terms of distributions made to today's generations versus distributions made to the expected distributions to the future generations. So flip to the next page if you would, and let's just take a look at some of the numbers. And we're certainly not going to go through all of these. We can answer any questions that you have on the specifics, but we'll just give you the high level overview here. As you recall, if we can get to a 50% probability of attaining intergenerational equity, that would be perfect. That's a perfect score is 50%. What that means is because there's risk around the assumptions that we make on those three items we just went through, we want to spread that risk equally across the generations. So a score of 50% means the risk of us being wrong on investment assumptions, say underestimating what we might earn, or overestimating what the land office may contribute to the fund, or severance taxes may contribute to the fund. Any mistakes that we've made in our assumptions, the risk of those are equally spread across the generations. If you get a number below 50, then that means the benefits available to future generations are eroded relative to those of today. In other words, today's generations are expected to be getting greater distributions from the fund in the future. And conversely, if it's over 50%, then it advantages future generations relative to the current in terms of the value of the distributions from the funds. So we target that 50%, or we like to see that 50%. But of course, that number really moves around. And so where are we today? If you shift to page 203 in your book, you can see the historic numbers for the land grant. So pretty good on land grant. For the most part, we stay between that 40 and 60 range. And you can see the numbers can be pretty volatile. But for the most part, we stay between that 40 to 60 range with a bias to the upside. So what that chart, what that chart's saying that you're looking at is there's a little bit of a bias in land grant, at least over that time, to benefit that the future generations will benefit a little bit more greatly than the current. But for the most part, we stay in that middle territory, which means it's around that 50% that we like to see. Severance taxes is, as you know, is not as in good shape. And we can go to page 207 to see severance tax. And you can see that's similar to land grant in that we sometimes hit in that gray zone between 40 and 60%. But for the most part, we're down below, meaning the future generations are unlikely to benefit from the severance tax as much as the present generation is. And that's just based on the assumptions around inflows to severance tax, which is probably the biggest issue with that fund, investment returns, and of course the current distribution policy. Like I say, it's around investment returns, it's assumption around inflows. One thing we do know with some reasonable certainty is what the distribution rate is. and we just expect whatever the current distribution rate is, that's what will be going forward. But recently we've had a change in the land grant distribution, at least expected. That's still something that needs to go in front of the voters for approval. But we've been asked to model what does that mean? What would that mean for the land grant? And that's on page 201 of the report. And if you flip there, you'll see some fancy graphics and lots of numbers here. But the effective annual spending rate, we think, goes from 5% to 6.08. The way the legislation has been structured. So if you go to the bottom of the page and you see the 5% annual spending rate, that's that current score of 61.7 that you saw on page 203. Moving it to an assumption of 6.08 annual spending rate, the score drops to 45.6. So about a 15 percentage point drop. So it goes from a slight advantage to future generations under a 5% spending rate to a slight advantage to current generations under that 6.08 spending rate. So that's just a quick overview of this, Governor and council members. Certainly have any discussion you'd like to have on it. We show this to you annually and try to keep everyone up to date on what sort of balance the funds have at the current time. So I'll stop there and field any questions, and also RBK is on the line for anything we might want to get in the weeds on.
Okay, thank you very much. Do we have any comments from any of the members? All right, well, hearing none, thank you for that report and keeping us updated. And with that, we're going to move to items or section 4 of the agenda, item 4A, and it's the Chief Financial Officer report. So, Mr. Shipp, you are up.
Thank you, Governor. I'll be quick. I'm on page 210 of the diligent materials. And I just wanted to point out a couple of things, if I may. Item number 1, as I normally do every meeting, kind of point out where we're at on the budget. We're not anticipating any budget problems through the end of the fiscal year. And then item number 3, the agreed upon procedures report. I noticed as I was looking at this that it says June 30th, 2020. It should be 21, but likely prior to our next meeting, if not right after it, we are anticipating the agreed upon procedure report for the third quarter. At this point in time, and based upon feedback that I've gotten from our external auditors, we're not anticipating any problems. If everybody could turn to page 212, I did want to point out on 212 and 213, especially 212, that middle section, the 300, if you recall from last month, there was a pretty large budget savings in that last column. It's dropped by about $4 or $5 million, and that's due to the fact that I've gone in on our various management fee purchase orders and adjusted those to get us through the end of the year. So usually as we get closer to the year end, the budget tightens a little bit, but I'm still anticipating that we'll have more than enough budget to get us through the end of the fiscal year. And then on the IHR report, I want to have everybody turn to page 252. This is the page that I like to focus on. It has the notes, kind of the highlights of the investment holdings report. You will note on bullet number 1 that the monthly contribution from the land office was $109 million during April. This was a big increase from March, and for comparison purposes, the April 2020 contribution from the State Land Office was $107 million. Certainly, a large part of the reason some of these numbers are increasing is because of the prices going up year over year.
Madam Chair?
Yes.
Go ahead. Was that the commissioner?
It is, and I just wanted to let folks know it actually is in fact another record-breaking number, and our early returns for May look to be possibly even higher than this. So we're just in kind of a flush period for our contributions.
Thank you, Land Commissioner, for that comment. I would also add, and I think the Land Commissioner has emphasized this in prior months, these distributions from the Land Office or contributions from the Land Office are about three months behind. So the numbers that you're looking at, while it's in the April report, it actually is for, I think, January. So there is a lag there. So just be aware of that. And then other than that, I did want to point out as we get closer to the end of the fiscal year, I think there was some new legislation regarding remote meetings and expense reports related to that. I just wanted to remind all members, if you have expense reports to get in, please do that. As we get closer to the year end, it becomes even more important. And with that, I think our audit committee chair, Nick Tejas, has some comments about the RFP process that we just completed.
Thank you, Member Tejas.
Oh, thank you, Madam Chair and Brent. Yes, as you see in your packets, we met a week ago, and we didn't really meet, but we evaluated the RFP for audit contracting services, and our evaluation committee was myself, Brett Shipp, and Michael Everett. Michael Everett is a advisory member on our audit committee, and we went through those proposals. They were very good. I believe there was 4 people that responded to the 4 companies that responded to the RFP, and there was a lot of good competition. But the evaluation scores really determined was that we would want to go with Moss Adams again. So with that, Brent, do you have any additional comments on that process?
No, I just wanted to emphasize, and I think I added it in my notes, for the evaluation committee, and I really appreciate Nick and Mike for their efforts. All the evaluators, while the evaluation scores might have differed relative to one another, the evaluators all rated Moss Adams as the top score. I might have had them higher. Nick might have had them a little bit lower, but we all had the same number 1, the same number 2, the same number 3. So Moss Adams was the firm that was selected. And I also emphasize, typically for the audit firms, especially if things are going well with the current audit firm, with the new audit rule changes that were just approved, you can now extend with the same audit firm for up to 8 years. We just completed the 3rd year with Moss Adams. This proposal was for 4 years. That'll take us to 7 years. We'll probably go out to proposal again at the end of the 7 year. There's no way Moss Adams would then be selected again because there's only 1 year available. But those are the only comments that I had on that. Other than that, I think we just need a motion to have that approved.
All right. Do you want to make the motion, Member Tejas?
Sure. Madam Chair, based upon the recommendation of the Council Audit Committee and SIC staff, I move that the SIC approve a contract with Moss Adams, LLP, to perform the audit of the State Investment Council's annual financial statements for the fiscal year ended June 30th, 2021, and complete the agreed upon procedure reports for the 4 subsequent quarters. As discussed, reviewed and memorialized by the council today, the term of the contract shall be 1 year with the option to extend for 3 successive 1-year terms.
Do we have a second?
I'll second it.
All right. Thank you, Senator Jennings. Do we have any questions or comments? Seeing none, I'm going to call for the vote. All those in favor of the external auditor decision or contract is the better way to refer to that. Say aye.
Aye.
Aye. Aye. Any opposed? Any abstain? Hearing none, the motion carries, and Moss Adams has had their external audit contract extended. We are now on item 5,
Governor?
Oh, yes?
Just before we get off this item in the investment holdings report, you know, I just have a problem with us when we take so much money from the oil and gas industry and have everybody sits there and kicks them in the teeth and we're still getting record money. Where's it going to come from if it goes away? I mean, that's all I got a question. I mean, who's going to fund U&M for those teachers when they don't get any oil and gas money? Who's going to replace it? You going to tax art? You going to tax kids? I mean, you know, we always kick them and we always kick them when we're down. Why don't we just say thanks? Sorry, that's my opinion.
Well, Senator, I appreciate it. I think that this council is working hard to be clear about investments that are cleaner, address climate change, which will cost far more than funding the educators doing that. But recognizing the value of the current assets and, like all of the work that we're doing, having a productive transition and being clear that we are analyzing those transition aspects and the opportunities, not just to diversify our investments, but to diversify the economy here. And frankly, you're seeing every oil and gas or energy state and all of the Western states particularly focused on identifying new opportunities, which is the job of the council, and 2, looking at those transitions. So I hope that no one here feels like it is a personal attack on industry, although there are some who are very concerned to the degree that I think have a very narrow view about how you might do a transition. And while I respect those opinions, I don't think that has been the reference point of the council, although it is clear that the priorities of this administration and many of us is to diversify and address climate change in as many ways as possible. I hope that contemplates and incorporates the feelings of this council and respectfully recognizes the position and points that you've made, Senator. Did I do that effectively?
No sense. You know, I think so. This is going.
I'm saying thanks.
I got it. And Senator, you are always appreciated, and we need you on this council. Okay, we are on item 5A, and we've got members Messina and members Allen. We are ready for you.
Thank you, Governor and Madam Chairwoman. Mike and I met on Saturday the 22nd to talk about the governance committee and also who might be chair, and we decided that I would be the appropriate chair for the governance committee because Mike is also co-chairing the investment committee. And what we would like from the council is just the endorsement that they would add me to the governance committee and therefore be the chair.
All right. Given our current circumstances and your level of expertise and your willingness to step up, I think it is the most effective way to both manage this issue and to also make sure that we get folks using all of their talents and expertise in the most meaningful ways. Is there anyone that objects so that we can? I think it's a perfect suggestion. Hearing none, we all are in agreement. So we will proceed in that matter. And Member Ellen, thank you very much for your willingness to serve in this capacity.
Thank you.
All right, we are now on that item, closing matters. It's agenda item 6A, old or new business. I don't have anything specific. I gave opening remarks about certainly COVID and thanking everyone for doing such incredible professional work during COVID and recognizing that my priority for the administration was to certainly engage and lead, and we were doing COVID 24 hours a day, 7 days a week. I'm still the named individual inside the governor's office responsible for COVID. Everyone else is taking on other challenges, but I'm still the lead staffer, at least from the office of the governor. So I really appreciate everyone's hard work and patience, and you should expect that I will be participating in the ways that prior to COVID that I was. But as a result, I don't have any old or new business except to restate my gratitude. Does any of the other members of the council have anything that they would like to share?
Governor, this is Member Messina. I just wanted to say I'm so hopeful that you reach a point where you determine that it's appropriate for us to meet in person. I so much prefer that. And I hope that becomes possible soon.
Member Messina, given that, we've made announcements about where the state will be on June 30th, declaring that July we're as back to normal as possible, but for, as to your point, some telecommuting that we hope the state and we hope private sector will engage and entertain while we adopted the CDC mask guidelines. I'm still a proponent, given that it'll take us a long time, frankly, to get kids who are currently eligible for a vaccine, and as we wait for the clinical trials, which have started, for our littlest citizens in New Mexico to be eligible for vaccines. I think that we'll be able to put out guidance, frankly, during June. State employees are beginning to come back June 1st in limited aspects. My office will be in the office 5 days a week together. We've got some small limitations in that regard, and we're reviewing our own mask wearing. We're all vaccinated in the governor's office. So we're going to put out even further guidance in the next week, and I will make sure that this council has it, and I will make sure that our investment officer, Steve Moise, has that. So I think that you should expect maybe one more meeting on the phone, if that, and we can begin to meet in person. And one of the issues is going to be, if we're not all vaccinated, what kind of social distancing and where, how we assess that in a way that respects privacy of all of the members, and whether or not, given that we're going to respect privacy, how we operate in the context of mask wearing. So we'll work with the staff on these issues, but expect that guidance about all of the above coming shortly.
Governor, this is Member Messina. I just wanted to thank you and commend you for your leadership on this dealing with the COVID situation. Our state's performance has been outstanding, especially compared to many others, and thank you for that.
Well, you're very welcome, and I know for all of us, it's more than a year. I mean, it's been a year and a half, and it's been really hard and long, and there's a lot to be proud of, and everybody on this council has done an amazing job, and I'm grateful. And for every New Mexican, frankly, that did 10 times as much to keep us safe and shouldered responsibilities for folks we, couldn't support or convince It just shows the power and the resilience of a state like ours, and I am too very proud of New Mexico. And I don't want to scare anyone because that's not the purpose of this meeting. But you know, we are watching what's going on, and certainly India, Brazil, Argentina. Now we're seeing some resurgence of these variants in ways that we have too much community spread in the United States. Currently, as you are probably all aware, the UK is getting nervous about another variant that appears to have significantly more community spread than they were anticipating. But again, and I said it at the beginning, with the U.S.'s strong vaccine response, which I credit this administration for, and given that so far these vaccines are holding against variants, we still feel very confident, but know that your modeling team, which includes the labs, will model every vaccinated breakthrough and every unvaccinated risk so that we as a state will always know what the likelihood of issues, whatever they are, and the prevalence of COVID will be, 6 to 2 months out. And we'll keep doing that for the next 12 months plus, and are well positioned to stay ahead of these concerning issues. So I'm as confident as you can be. I feel really good. All right. With that, we're on item 6B. It's the next State Investment Council meeting. It is Tuesday, June 22nd, and we'll by then, it's quite possible we could work things out to meet in person. And as I said, we'll put out guidance, and the entire council will get it, including all of the members, and your input based on the parameters that we're setting and guidance and recommendations, largely not mandates, but recommendations we'll be setting. That would be helpful, I know, to the state investment officer and to the staff, and certainly to me as the chair in making those decisions. So stay tuned. And thank you. And our next item, we are now on agenda item 7, which is the public comment period. And to other members and the investment officer, I might need a little help on this. Are we reading comments, and do we have folks who have participated through the whole meeting? And is there someone who can manage their questions or comments if they're on the phone with us right now?
Governor, I think Charlie can handle this for us. Charlie, would you do that, please?
Yes, Governor, and this is an easy one. We request public comment be submitted when we send out the meeting notices, and this month we have not received any public comment.
Okay, well, I appreciate that, and thank you for having my back, and I appreciate that, so that I knew how we were handling the public comment period, and frankly, requirements that we engage the public on our activities so that we meet the requirements of the Open Meetings Act, and more than that, that we engage as many New Mexicans as possible. With that, we are now on item 8, which is adjournment. I would entertain a motion to adjourn.
I would so move.
Thank you, Senator. Do we have a second?
Second.
And who is the second? I couldn't hear.
This is Chairman. I'll second.
All right. Thank you very much. We have a motion to adjourn and a second. We are ready to call. All those in favor of adjourning the meeting, say aye. Aye.
Aye.
Aye. Any nays? Any abstain? I want to thank you all for participating and, again, your patience with me. I am so looking forward to seeing all of you as soon as we safely can in person. And I thank everyone for an incredible year and a half.